Dennis, over the course of the past week, we've seen some major sell-offs and some strong gains. Talk to us about what's moving markets these days.
Sure. So I think there's a few things that are moving markets and causing that extreme volatility, some of which I can speak to knowledgeably, some I can't. So earlier on Monday, we heard talk of the technical setup of the market. I think that's simply industry jargon for saying that things had gone straight up and were probably slightly overbought and were due for a correction. The second thing we heard, of course, was the rise of the Delta variants. And this is an even more infectious strain or mutation of an already very infectious virus and disease with a higher mortality rate. So there were concerns that it would derail the reopening trade and the reopening process that we're seeing. So that was a concern. And then, of course, we've had a very strong rally for the first half of the year. North American equity markets are already up double digits. So it stands to reason that they weren't going to go straight up throughout the end of the year. So we're probably due for a check back anyways. And inflation, I should say. There are also concerns about, quite frankly, I've heard the term stagflation from a number of trusted resources in the last couple of weeks. So that is an economic situation where growth is low and conversely inflation is high. We haven't really seen that in a meaningful way in a number of decades. So, and obviously it's a very destructive economic environment for wealth accumulation and creation. So I think the combination of all of those factors just caused the market to step back briefly. But we're followed by a very, very strong rally. In our case, we actually made back more on Tuesday than we lost on Monday. So net, if you'd gone to sleep Sunday night and woke up Wednesday morning, you wouldn't have thought anything untoward had happened.
Now, some analysts have suggested that we've been in a correction for the past few months. How do you see this playing out for the rest of the year? Are we going to continue to see this volatility?
Yeah, I think it depends on what asset classes or sectors you're invested in. I mean, from our standpoint, we own real estate and infrastructure. So you'd be hard pressed to say that you were in a correction for the last 2 months, given the returns are very, very strong over that 2 and 3 month time period for those asset classes. Then conversely, if you're invested in, say, financial services or energy, while they've had phenomenal starts to the year, in more recent times, they've checked back a little bit. So it really does, this is, every portfolio manager likes to say you have to be a stock picker. In this environment, you have to first be an asset allocator, right? So you've got to determine what sectors and subsectors within those sectors you're going to allocate capital to and why. And then once you've made those decisions, you've then got to be a stock picker, because not all companies are created equally. And what you're seeing, particularly during an earnings season like we're in now, is that companies that disappoint or miss are being severely punished. Whereas companies that meet or beat and exceed or even raise guidance aren't being rewarded as handsomely as they have been historically. So it really is an asset allocator, then a stock selection market for people looking to allocate capital.
You had mentioned some of the factors playing out in the backdrop. Let's just expand on that a little. Fiscal stimulus winding down, the possibility of the Delta variant ramping up. Possibly we might see the economy getting shut down again. As an investor, what is your biggest concern when you take a look at all this underlying activity?
Right. So a couple things we'd say is that it's not so much fiscal stimulus winding down, it's actually still ramping up. You do have the American Jobs Plan that is still to be voted into legislation later this year, which is north of $1 trillion of stimulus out of the United States. So there's that plan. And then in terms of the Delta variant, we think the concern isn't necessarily economies shutting down. I don't think there's a political appetite or a social appetite for that. What it does do is it delays the return to work, however. So, I mean, if you can't convince school teachers to come back to school, then you'll have a hard time getting, well, obviously then students won't be in school, which means parents have to remain home to look after them. And in industries where it's not possible to work from home, that means it's more and more difficult to get people to come to work. Anecdotally, we've heard from a number of industries, employers having to offer signing bonuses, higher wages to entice employees to come back to work. And it's not because of this tired narrative that they're making more on benefits not working, because anybody with a long-term focus beyond 2 or 3 months recognizes that those benefits are going to roll off and expire, and and then you're going to need to replace them with something. It's because these people legitimately feel that their health is at risk if they're returning to work, and or they don't have anyone to look after their children if they return to work. So all of those are factors that are creating market volatility and uncertainty in the short and intermediate term, we would say. But the great, if you, so much as you can say there is a great ling or a silver lining here, is that these should be temporary and transitory in nature. I would say that in Q1 of next year, we should be well on our way to economic reopening just about in every major economy that drives equity markets. And as a result, equity markets should reflect that.
You mentioned the short term and the intermediate with respect to investing in the markets. Let's talk about the short term versus the long term. Do you stay invested in the stocks that had a good run, like the stay-at-home stocks, the tech stocks, or do you consider other options as we kind of look to get out on the other side of this?
If you're truly a long-term investor, then there are a number of big cap, large technology companies that you can allocate capital to. I mean, Apple and Microsoft have had fantastic runs. Amazon is obviously a juggernaut, sending its founder to the moon, or sorry, to space. But these are large cap companies that have had a great run. They're clearly part of the reopening trade, and as we shift to value, those names have not kept pace with some of the value names. But if you're truly a longer-term investor, I mean, even the U.S. government couldn't shake Microsoft and break it apart. So those are companies you can allocate capital to for the long term on dips and allow them to compound for you over an extremely long period of time, and you'll be well rewarded. Other companies are a little more skewed towards sort of the reopening trade. Disney is a great example, where they've got a not immaterial amount of their cash flows and earnings coming from theme parks, entertainment. And so as we reopen, those parts of Disney's business should also start to accelerate and pick up and start to drive more of the earnings picture, supplemented by Disney Plus and the continued monetization of what we think is the world's greatest portfolio of IP, intellectual property. So it really does depend on whether you're a long-term investor or a short-term investor, but I would say this: you're always going to want to allocate capital to great businesses, and you're going to want the businesses to do the heavy lifting. We like to pretend in this industry that, the smart people are always, the smart money or the smart managers are the ones who generate all the returns. Nothing could be further from the truth. It is truly the businesses that do the heavy lifting. And for those of us who are patient enough and disciplined enough to allocate capital to those great businesses, they reward us over long periods of time.
As an investor, are you concerned about what central banks are up to?
Certainly. Central banks are probably the number one sort of macro driver for every risky asset and obviously risk-free assets as well. So what we are engaged in is we're engaged in a long-term sort of interest rate normalization period. And that's happening as we speak, headlined by the Federal Reserve Bank in the United States, where between now and call it the end of 2024, they have to engage in a tapering process to end their bond purchases and their mortgage-backed securities purchases. And then they have to begin the process of normalizing interest rates. That is bringing the federal funds rate to the non-accelerating inflation rate of rates, such that they're not stimulating economic growth and they're not curtailing it. That is a tricky endeavor at the best of times. And given everything that is taking place in the global economy right now, I wouldn't envy them their job. But sometime between now and, say, the end of 2024, that is in fact what they have to accomplish without inducing a recession.